Good day, traders. Hope you guys are good and welcome to my trading space. In today's video, we're going to be talking about liquidity. As the title has suggested, everything that you need to know about liquidity. There's a video that I uploaded a few weeks or months ago, and it's part of the Inception series, where I was explaining the theoretical part of liquidity. If you still haven't watched that video, a link to that video will be made available in the description box below. Now, in that video, I never really explained how that works in a real trading environment. And that's the purpose of today's video. So we know that liquidity describes the availability of an asset class. So in the market, for the sake of simplicity, we'll think of the market as just being a mere interaction between retail traders and market makers. In a trading environment, right, for you to be able to execute whichever order that you want to execute, you have to have someone on the other side who's willing and able to match your offer. So for retail traders, those people are market makers. For market makers, those people are retail traders. Right? Like I said, there's more to it than that, but like for the sake of this video and for the sake of simplicity, you have to use this model, right? So we already know what liquidity is, and liquidity exists in two forms. It exists in stop losses and also in pending orders. So what do I mean when I'm talking about pending orders? I'm talking about buy stops, and sell stops. So, okay, before we go into the chart, here's an example of how or where you would find liquidity. So assume that price was going up, got into this area and started forming a consolidation. From this consolidation, stop losses will be resting below this area from people who are buying here. Sell stops will be resting below this area from people who are expecting, or retail traders who are expecting the market to drop after this consolidation. The opposite is true. Stop losses will be resting above this area from people who are buying from the support, from this resistance, and buy stops will be resting above this area from people who are expecting a breakout to the upside and they don't want to miss out on this breakout. As a result, because of the large participants or because of the large volume from retail traders, this area below and above this has a lot of liquidity, has a lot of money from retail, from retail traders to market makers, right? So what normally happens, and I've shared this in the market manipulation video, what normally happens is the market makers will choose an area where they will tap into the orders, right? So they will trigger all the buy stops, trigger all the sell stops, right? And then as soon as they get people to buy, as soon as they lure retail traders to buy, they can now activate their cells. And that's when you get a reversal in price. Now, for you to understand or for you to know that indeed what you saw was a liquidity trap, this movement over here, let me just highlight it. The reversal back into that consolidation is usually larger or is usually fast. Now, when we're talking about speed in the market, we're talking about the size of the candlesticks. How many candlesticks did it take from the market for the market to move from point A to point B, right? If the amount of candlesticks that it took to move from, say, here are way more than the amount of candlesticks that it took the market to move from here to here, it means that the market here was way faster than this movement over here. So this is the general idea. Now let's see how that applies to real markets. Here's a basic scenario. You have support, right? And you have your initial move to the downside, you have a retest. What will happen is people will place they sell orders on this area over here and they stop losses above this area. Now, because of this strong move, breakout candlestick or breakout traders will place their buy stops above this area because they don't want to miss out on the movement upwards. Also take into consideration the fact that the market has been making higher highs and higher lows. But then what happens? As soon as the market fills in all the stop losses that are resting above this area, and as soon as all the buy stops are triggered, price reverses. And again, look at the amount of time it took the market to move from here to here, for example, versus the amount of time it took the market to move from here to here, right? Here is a general example of a liquidity grab. Call this type of liquidity a buy stop liquidity. Right? Because the buy stops here were triggered, sell stops here were triggered, the stop losses, not sell stops. Buy stops were triggered, stop losses were triggered. And as soon as they were triggered, there were eventually people who would buy from the market makers. So we already know from our previous videos that there are areas in the market where large participants, including market makers, already have their orders, right? We already know how to identify them. And if you look to the left, you will actually identify them. So look at where this thing turned. It took out these buy orders, right? And as soon as they were triggered, they went into an area where there were a lot of unfilled sell orders from market makers. And then price was able to move downwards, right? Let's look for another scenario. Now you have this turn, first retest. Look what happened during the second retest. The market triggered sell stops before going up, right? Went again, took out the sell stops again before going up. Now, in this instance, this is called a sell stop liquidity. We already know the rules for trading using order blocks or areas of supply and demand, right? So where do you find this liquidity pool? It's called a liquidity pool. A liquidity pool describes areas where you'll find a lot of liquidity. You'll find them at old highs, old lows, equal highs, equal lows. Generally, retail traders consider them as areas of support and resistance. Here's another perfect example, an old high, right? People have their sells waiting on this area, stop losses resting above, right? Now, because of this correction that was going on here, you will find that there were people who had also their buy stops resting above this area, waiting for the movement to the upside. But then what happened? You got a liquidity grab. You got a liquidity grab and the market went down. So this is a lesson for all of you support and resistance traders. Not every area of support and resistance is your friend, because if they are obvious, there are obviously a lot of people who are waiting to trade the breakout. So they have the stop losses or the pending orders resting below and above those areas. And if you're already in that position, you are placing your stop loss below and above that area. So it creates liquidity for large market participants, and they can easily use that liquidity to trigger their original orders and make the market reverse into the opposite direction, right? Even if you can look here, what happened when the market went back for a retest? It took out stop losses from people who had their buys over here. And what happened to those who were willing to sell? It also took them out before going into the direction that it intended. So as I'm concluding this video, remember that the market moves with an agenda. And the agenda is always to fill in unfilled orders from market makers, right? If you have a large imbalance, the market will eventually find its way back to that imbalance to fill in the orders that are resting there. But what will it need? It will need a lot of participants on the opposite side to fill in those orders. So if you have this instance over here, where the market was going up, right? And you can lure people into buying the breakout or placing their buy stops in anticipation of the breakout. You can get enough buyers to sell to, and you can eventually make the market. Okay, let me adjust this. And you can eventually make the market to reverse into your anticipated direction. So that's the lesson for today. Being able to identify areas. This is a potential area of liquidity also. All right. So that's the lesson for today. Being able to identify the areas of liquidity. This is all I have for you guys. Hope you guys enjoyed today's lesson. Subscribe if you still haven't. Watch my other videos if you still have a lot of catching up to do. Till we meet again, peace.